Hey, Michael, how are you?
Hey Michelle, how you doing today?
Good, thank you. So today I have Michael Abram from CrossCountry Mortgage, and we are going to talk about interest rates, of course, and we're going to talk about how the mortgage industry, I think, today has found some creative ways of helping buyers buy properties and also helping sellers sell their property because we know that interest rates have gone up a lot and properties are, tend to sit on the market a little bit longer. And so there are some ways to kind of circumvent these very, very high rates and make the deals happen. Is that
Yeah,
right?
yeah, absolutely.
Yeah. So I think you had mentioned to me something earlier called a 1-1, a 2-1, a 3-2-1. So if you want to kind of explain that to us in layman terms of how, how these deals are happening and what it means for the buyers and for the sellers.
Sure. So, I mean, what we're experiencing right now is interest rates are the highest they've been in the last 20 years. So, with home values still sitting at the range they're at now, and where the interest rates are, it's become very difficult for people to afford the payments. So, what you're referring to is something called a temporary buy down. That can be done as a 1 year buy down, a 2 year buy down, or a 3 year buy down.
Right.
So what that's doing is lowering the interest rate for the person either the first year, or it's lowering it the first 2 years, or it's lowering it the first 3 years. So it's making the payments more manageable for buyers. And at the same time, we're still qualifying them based on the rates right now in this market to know that they can afford the payments.
Okay. All right. So, give us, well, you're going to give us an example, but before you give us an example, explain, like, let's say, for instance, a 2-1 buy down. How would that work?
Sure. So, I mean, let's just say hypothetically someone has a 6% interest rate based on today's market.
Hmm.
Okay. The 2-1 buy down implies that the first year that your client buys the house, they're paying 4% on
So
their
2%. So that's where the 2-1 comes in. They're going to
yes.
pay 2% less in interest, mortgage interest than the original 6%. So the first year, instead of paying 6%
Mhm.
interest rate, they're going to pay 4%. That's the
Correct.
two. Okay.
Correct. And then the next year, they're only going to be 1% lower. So their interest rate's going up from 4% to 5%.
5%. That's
Right.
the one in the 2-1. Got it.
Correct. And then that third year, they go back to the original 6% interest rate on their 30-year fix. And it is still a 30-year fix. So the rate does not change anymore. It's still a 6% interest rate, assuming they don't refinance.
For the remainder of the loan. So in case of like
Yeah.
most standard loans, if it's a 30 year loan, first year 6%, but they're actually going to pay 4%. Second year, they're going to pay 5% interest rate, and then third year and for the remaining 28 years, they're going to pay 6%. Again, as you mentioned, assuming they don't refinance their loan if or when interest rates go down.
That's correct. Yes.
Great. Okay. Do you want to, without going too much into numbers, can you give us an idea of what this would look like for a purchase price? I think you sent me something earlier for a $675,000 purchase with 20% down. What would that look like?
So let me pull that real fast. My apologies because I
Oh,
don't.
okay. Well, I have that. I have here on my screen. So I think for the first year at 675 with 20% down, the loan amount would be $540,000.
Right.
And if they were paying 6.5%, they would be paying approximately $3,400 a month. But they
Hmm.
would actually be on a 4.5% loan, and that would bring down their mortgage to $2,700 a month um, for the first year, and then the second year they would be paying 5.5% because we're now going up by 1%, and they would be paying $3,666 a month in mortgage.
Okay.
So yeah, so that's a
It's a
significant,
sizable amount.
it's a sizable amount, it's a sizable savings, and it just makes it easier, especially for those two first years when you're a buyer, sometimes a first time buyer. The first couple of years, you've got maybe you have to buy furniture, new furniture. Maybe you want to do some improvements on the home, maybe put in a new kitchen, change the floors, paint, anything like that. It is definitely helpful those first couple of years to have some money coming in or less money to have to pay on your mortgage.
Yeah, it's increasing their cash flow,
Right.
so that they can set their home up. Yeah, and that's
Right.
the whole point. We want to make sure that it's affordable still to own a home. And
Exactly.
that's
Yeah.
why this concept has been so wonderful and it's really picked up steam in the last 6 months.
Right. How are you finding sellers cooperating with these kind of, because it's cost, because the money has to come from somewhere, right?
Yeah,
Talk a little bit about that briefly, and where the money comes from and where it goes and for how long.
right. So there's always a catch, right? So the credits here for the buy down can only come from three different parties. It can come from the seller, it can come from the builder or developer, like in a new construction,
Uh-huh.
or it can come from the lender. The problem with the lender side of it for me is that the math is never going to work out to
Right.
where I can help them like that, unfortunately.
Yeah.
So we focus on the seller or the builder and developer, being your primary options to get that credit.
Sure.
And we are seeing sellers being very open at this point to the buy down costs. I mean, as long as it's a reasonable amount and
Right.
there's no bottom line that they may still have to hit for whatever reason, we're seeing sellers meeting buyers halfway to get deals closed so
Wow.
that
Okay.
they're not
Yeah.
sitting in the
Yeah. We're
market
seeing
for.
that also on our end when we're presenting
Yeah.
offers for our buyers. Sellers, especially for those properties I think that have been sitting on the market for a little bit longer than what we've been used to in the past couple of years, where
Yeah.
properties were flying off the shell in a couple of days, literally. Now we're seeing properties, on the market for a month or so. Sellers are, getting a little itchy and they wonder what's going on with their listing, and they're a little more open to receiving, these kind of offers where they're going to be helping the buyers with their interest rates.
Right. I think what we're seeing is, and correct me if I'm wrong, but now sellers are starting to see and hear more that buyers can't afford it. It's too expensive. That it's not that they can't afford the payments, but it's really pushing them against their comfort levels. So it's not really like a propaganda. There's nothing out there that's, a conspiracy against sellers. It's simple math that's just pushing payments
Yeah,
too high. And so if you want to get that deal done and you're not
yeah,
getting a ton of offers, but you get something that's a reasonably good offer,
right.
it's something to look at and consider.
Right. And especially, I think it makes a lot of sense for a buyer because those couple of years are actually a couple of first years are actually going to bring you back down to a very reasonable level, 4.5%, five and a
Right.
half percent, which is extremely reasonable. And then we're hoping and kind of predicting that eventually the rates are going to come back down, maybe in the next year or so, maybe in 2024. And so I think you're expecting a lot of people to refinance their loan to lower rates. So at that point, they'll be able to just not even have to deal with that higher 6.5% rate and just refi into a lower interest rate. And I think you mentioned earlier, before we started this call here, that
Mhm.
there might actually be some money left into that hold account where that money is going to be accumulating from that buy down. Is that right?
Yeah, that's correct. So, I mean, we do calculate out to the exact dollar how much that buy down cost is for your client. And that's the exact amount that goes into this holding account with the bank. But at the end of the day, if we do have a recession next year and someone's in a position to refinance, what do
Mm-hmm.
you do with all that extra money in there? Because,
Sure.
if you let's just say you had $20,000 in this account, but you've only put in about $6,000 at that point when someone's looking to refinance. Well, you've got $14,000 still sitting in this account. And this money, this buy down whole concept was designed to help the buyer, right?
Sure. The
Well, that money
consumer.
is still there to help the client. And we will use that money then on the subsequent refinance to pay their closing costs,
Wow.
to push their interest rate lower, using it to buy down points, for
Sure.
whatever the cost is. So when you think about the long-term benefits, the buyers are going to be in a position to not only take advantage of a refinance at some point, hopefully in the next year, but if there's money left over, it's going to help them push the rates and payments even lower than the current market. And all of this was done on the money that originally came from the seller that they bought their home from.
That's fantastic. So yeah, this is like they're getting the best of both worlds. The first couple of
Yeah.
years, or maybe even 3 years, but that's probably getting a little expensive at 3 years on the seller side. But let's say the first couple of years, they can actually bring those high rates down, so they're not really suffering too much those first 2 years. And then at the end of the 2 years, they're gonna refinance to the new rates at that time, which hopefully will be again in that 5% range. And the cost of refinancing might be paid by some leftover money in that hold account for closing cost, appraisal, or even paying some points to bring that interest rates at that time even lower. So I'm not
Absolutely.
sure if we confused everybody at this point or not, but we're gonna have your contact information down below here, and anybody who's got questions. I know you're very patient, and you'll explain that to our clients. But I think it's a great way for the mortgage industry to have become a little creative to circumvent that really high interest rates that everybody is paying right now, and for also to help sellers, participate in that painful high interest rate, and help the buyers buy their properties.
Yeah, absolutely. Michelle, one last thing on the whole buy down thing, because a lot of people out there will think about the word points, buying points, discount points to push their interest rates lower. So if you just sometimes look at the math side by side, and this is just where talking to a lender comes in handy. You just look at the difference of applying a buy down concept versus taking that same dollar amount and paying points to buy the interest rate down, and
Right.
you always see that the buy down will be more
Makes more
advantageous
sense.
to the buyer.
Yeah, 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 yeah. That's a great point. That's a great point. Speaking of points. So, all right, Michael. Well, as always, thank you so much for your time and your expertise. Really appreciate it. If
Got it.
you have any questions, anybody, please reach out to Michael. Get pre-approved. It's actually still a great time to buy homes out there. There's definitely some great opportunities, especially right around the holidays, because there's less competition. And so you may even be able to negotiate even better deals. And for sellers, there's still a huge demand out there, and prices really haven't come down by much, if at all, especially in Los Angeles, and especially on the west side. So everyone, thanks for checking in. Michael, thanks for your time. Have a great
Got
rest
it.
of the week, and we'll talk to you later.
Sounds good. Take care.
Thanks, you too.